Hey, welcome back to The Explainer. Today we're going to talk about something really cool, a powerful option strategy that lets you generate income from companies you already love. And the best part? Your risk is locked in and defined from the moment you start. All right, let's get right into it. So let me just ask you this. What if you could actually get paid, like cash in your account right now, just for being bullish on a great company? Think about it. You're just waiting for them to do what great companies do, grow. Well, that's exactly what this is all about. It's a way to pull in some income while knowing exactly what your downside is from day one. Okay, to really wrap our heads around this, let's forget about the stock market for a second. Yeah, I know, but bear with me. We're going to use a super simple analogy that I bet you already get. Smartphone insurance. Seriously, this makes the whole thing click. So the strategy we're talking about, its official name is the bull-put spread. All that means is it's a way to bet that a stock is going to go up or even just stay flat. You get paid for that belief, but, and this is the important part, it comes with built-in protection. It's designed so you can sleep well at night. Now, let's jump back to that insurance example to see exactly how that protection works. Okay, here's how it works. It's just two simple steps. Step one, you become the insurance company. Let's say your friend has a $1,000 phone. You tell him, hey, if you break it, I promise to buy it from you for $900. For that promise, he pays you $50 right now. Simple enough? But wait, you don't want to be on the hook for that whole $900, right? Of course not. So, step two, you buy your own insurance. You turn around and pay a big insurance company, say $20, for a policy that lets you sell them that broken phone for $800. See what you did there? You've already capped your risk. So what happens then? Well, there are only two ways this can play out. The best case scenario, the phone doesn't break. Awesome. Both insurance policies just expire, you collected $50, you paid out $20, so you just pocket the $30 difference. Easy money. Now, the worst case, the phone breaks. You have to honor your promise and buy it for $900. But remember your backup plan? You immediately sell it to the big insurer for $800. So you're out $100 on that transaction, but you started by collecting $30. So your total maximum worst possible loss is $70. That's it. It's capped. No scary surprises. Okay, so how do we take this whole phone insurance thing and apply it to the stock market? It's actually a perfect one-to-one translation. The friend's phone, that's just the company's stock. Your promise to buy the phone if it breaks or drops in price, that's called selling a put option. And that backup policy you bought for protection, that's just you buying another put option at a lower price. That's your safety net. That's the whole spread. All right, so now you get the what. But honestly, the real secret sauce, the key to making this work, is the when. It's all about timing. There are a couple of key triggers you want to look for that really stack the odds in your favor. And here it is. This is absolutely critical. You want to use this strategy when a great company, we're talking a solid business, has a temporary sale, a pullback. This is usually when everyone else is panicking, and that fear makes something called implied volatility, or IV, go through the roof. Think of IV as just the price of options. When IV is high, you get paid way more for selling that insurance. So you're getting paid more to make a bullish bet on a great company that's on sale. And then, as the fear dies down and the stock starts to recover, that IV gets crushed, which is a second way you profit. It's like a perfect storm working for you. Now, another huge piece of this puzzle is giving yourself plenty of time to be right. You need breathing room. We're not talking about short-term 30-day gambles here. No way. We're talking about looking 6, 9, even 12 months into the future. And there's a very powerful reason for that. When you go out 6 to 12 months, your trade can absorb shocks. Some random bad news or crazy market day can absolutely wreck a short-term trade. But a one-year trade, it barely even flinches. It gives the great company you picked the time it needs to weather the storm and let its real value shine through. It basically solves that incredibly frustrating problem we've all had, being right on the company, but just getting the timing wrong. Of course, nothing's a free lunch, right? There are trade-offs. When you go this far out, that profit you get just from time passing, it's called theta decay, it happens much more slowly. And yeah, your money is tied up in this trade for a while. So you're basically making a choice. You're trading a potentially faster, more aggressive return for a much higher probability of success, and frankly, for peace of mind. Okay, now for the pro move. This is the part that really separates the amateurs from the pros. It's a bit of a paradox. You set up the trade for the long term to be safe, but you manage it like a short-term trader to lock in cash. See, the pros almost never hold these things all the way to expiration day, and here's why that's so smart. Because when you're right, when that great company bounces back hard like you thought it would, something magical happens. The stock price shoots up, the fear vanishes, and the value of the spread you sold just collapses in your favor. And it happens fast. It's totally possible to capture, say, 65% of your maximum possible profit in just the first month of a 12-month trade.
I mean, look at this. It really puts it in perspective. You've made 65% of your profit in 1 month. Why on earth would you tie up your money for another 11 months just to fight for that last little 35%? It just doesn't make sense. The smart move is to take your winnings off the table. This is what people call capital velocity, getting your money working for you again on the next great idea.
So let's just nail this down. Why close early? 3 huge reasons. 1, you cash in on the stock bouncing and the fear dropping at the same time. It's a double win. 2, you get your money back. You can immediately go find the next great setup. And 3, and this is so important, you take all future risk off the table. A win is not a win until you lock it in. So you see, when you put all these pieces together, picking a great company, waiting for it to go on sale, giving yourself a long runway, and then taking profits early, it's not just a one-off trade anymore. It's a repeatable blueprint. It's a whole new mindset for how you can approach the market. And really, it all comes down to this one crucial shift in how you think. You have to stop trying to be a fortune teller. Stop trying to predict the price tomorrow. That's a losing game. Instead, you just position yourself. You position yourself to profit from something we can be much more certain about: the fact that great companies over time tend to go up. Hey, so if this breakdown helped things click for you, if you now see how you can use moments of fear to your advantage, do me a quick favor and hit that like button, and definitely subscribe to The Explainer for more. We love breaking down these kinds of powerful ideas. Thanks so much for tuning in. We'll see you on the next one.